All right, it's Humphrey Hawkins. So anything can happen today. Right now, we're looking at futures down with 30 minutes to go until the start of cash trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
And coming up, Powell heads to Capitol Hill. The Fed chair faces tough questions as Trump policies spur caution.
Sam Altman says OpenAI is not for sale and blasts Elon Musk's tactics in a Bloomberg scoop.
Meanwhile, Meta's rally makes history as Mark Zuckerberg's AI bet starts to pay off. Stock still looks relatively cheap, though. All that and more coming up. But let's take a look at where markets are trading. Like Matt said, 30 minutes until the bell. You can see we're taking a bit of a breather today. We had a big start to the week yesterday. The S&P 500 right now in futures trading currently off by about 0.5%. Big tech even more. Of course, we're coming off of 2 straight weeks of losses, and you can see some of that weakness coming in the pre-market right now. The Nasdaq 100 down about 0.8% if you round there. And the bond market, keep an eye on that one. Of course, the 10-year Treasury yield currently higher by about 3 basis points. We are back above 4.5%, Matt Miller.
Back into the danger zone. Okay, as we get closer to the Senate grilling of Chair Powell, let's take a look at how the Fed is set up in terms of risks to inflation or risks to jobs. Here we have in blue the number of Fed officials who are worried about inflation risks to the upside. Now 15. That's the highest level since 2022. In yellow, you see the concern about the jobless situation, and that has come down as unemployment dropped to 4% even.
You've got the macro, I've got the micro. It is still the season that never ends. It is earnings season, and we have some stocks we're watching because of it. Shopify is now up about 2.3% pre-market. It has been fluctuating. It plunged as much as 9% this morning despite a revenue beat last quarter and an outlook that's mostly in line with expectations. Now higher, though. Coca-Cola up about 4.3% pre-market. It topped estimates as global demand for beverages rises. Consumers are willing to pay higher prices for drinks, with sales growing 6% last quarter. We're going to talk a lot about the consumer. Supermicro now down almost 5% pre-market. They're going to release an update on its business today. It struggled with AI demand following accounting issues last year, but some investors are still optimistic. Its stock is up some 60% in the past week, Matt.
Yeah, the question is, do they get to stay in the NASDAQ, right? If your accountant says, we can't verify this accounting anymore, we quit, that's usually a bad sign.
Yeah, but, they found a new one. I'm looking forward to that business update. We have a lot of testimony to get through before then, though. I'm pretty interested. I know that, you're back and forth on whether you care about the Fed.
I always care. The question is, to what degree is it really driving the trade?
What I'm interested in, of course, there's the politics of it all, but there's also a lot of subjects that Powell doesn't like to talk about. I'm talking about fiscal policy, of course. He can't make monetary policy in a vacuum, and we know he's going to be getting some questions when it comes to tariffs, immigration, et cetera, what that means for inflation, what that means for growth.
It'll be quite frustrating. And of course, you have a lot of lawmakers that feel very frustrated, not about that short end of the curve, but the long end of the curve that perhaps are more linked to mortgage rates. People in their districts can't buy homes. And so you have a lot of things that are kind of outside of his control. So a frustrating 24 hours that will lead us, of course, into the CPI data tomorrow, which is another big moment for this market. Debatably, I know, but people are already trading around it, buying straddles in case of any moves in the S&P 500.
Right, I never say the Fed doesn't matter. I just say it matters less at times and more at others. Let's bring in Marianne Bartels. Let's get to Mike McKee first for a preview of Powell's testimony. I almost skipped over you, Mike, because I'm looking at Marianne over here on set. We'll get to her in her winter white. But first off, what are we waiting for this afternoon?
Well, we've already gotten a comment from a Fed official this morning, Beth Hammock from the Cleveland Fed. She's in your blue group, Matt. Worried about inflation, saying the risks are to the upside and that monetary policy should stay on hold for a significant period of time. Now, do not expect Jay Powell to take that kind of a firm stance on policy. He's going to have two audiences today, one Wall Street, one the banking committee members in the room. As for Wall Street, he doesn't want to be firm in what he's going to do because he doesn't want the markets to move much since he doesn't know which way he's going to want them to move. But he does have a problem that reflects what Hammack's comments said today, and that is that the dollar, a little lower today, but has been strengthening, and any thought that rates are going to stay higher for longer will push it up and have a negative effect on corporate profits and also reduce the impact of any tariffs. Also, inflation expectations rising. We saw that with the University of Michigan. And if you look at break-evens on Wall Street, they have been rising since Trump took office. And that's something the Fed is going to have to keep an eye on. But also, he does have the banking committee. He's going to have to talk about things, as you mentioned, he doesn't like to talk about. One will be DEI. The Fed is an independent agency, but has taken down its DEI website. Whether the officials will press him to do more or less, we'll have to wait and see. But remember, their whole monetary policy strategy was based on letting the economy run hot to help lower income people get jobs. He'll also probably be talking about bank regulation. There'll be a lot of questions about that and what's going to happen now that Michael Barr has resigned and we have a new administration in place that wants less regulation. And also, he's going to probably be asked about where they go from here in terms of their review of policy. Do they keep that run it hot philosophy going forward?
All right, Mike, we're going to check back in with you in just about 55 minutes from now, ahead of the testimony to get us set up for that on Capitol Hill. Let's bring in Marianne Bartels, Sanctuary Wealth Chief Investment Strategist. And, you know, we always sort of had this debate. I know, obviously, whatever Powell says can move the 2-year dramatically in the moment. But how much does it matter right now to the market since we know, essentially, that the Fed is on hold?
I think CPI is going to be more important than Powell's testimony, the actual real data. The markets are worried about tariffs because we talk about them every day, right? And then Trump is doing something with tariffs, it feels like almost every day. But I went back and looked at his last administration, and when he left office, CPI was 1.4%. The tariffs that he did implement during his last administration didn't result in the long term with inflation. So although I think the markets will be concerned and investors will be concerned about inflation, I'm not concerned about inflation. I'm not seeing it priced in the market. In fact, technically, as I look at the 10-year, it's formed a head and shoulders pattern and broke down. So there's a good chance if we get good inflation data this week that we can actually see the back end of the curve actually drift down. And on the opposite end, it's possible I'm getting bullish technicals on the equity market. When was the last time we had the equity market going up and the bond market going up? And I think if that happened, that would be what's unexpected in the marketplace this week.
Interesting. So how do you invest around that sort of nonchalance you have when it comes to inflation? You're not seeing it in the market. It seems like the technicals are lining up as well. I mean, is that a blanket buy at the index level, or are there specific parts of this market that you would target here?
So I'm pretty bullish this year. I still think the markets can be up 20% this year. Going back
20%.
20%.
So like 7,200.
Correct. So my range is 7,200 to 7,400. The last time we had 3 years of a market that was able to grow 20% or more was back in the 90s. So I equate all of this AI, robotics, blockchain, crypto, this huge innovation bucket being bigger than what we even saw in the 1990s. And I think based on earnings, based on technicals, we can have the market going up despite the market having a very high valuation. I wouldn't be surprised if valuations are able to continue to expand. But to get to your point, what do I like? What's most important to this market is leadership, and technology is the leadership. If technology can come back, and it's been churning, and I just got a buy signal, short-term buy signal, that leadership should drive the rally.
How necessary is that? Because something I was looking at this morning was the S&P 500 relative to the NASDAQ, relative to the Russell 2000, as we've been watching for the last year, it feels like now. and what it looked like compared to the S&P equal weight. Because in January, you did see the equal weight really come back in a significant way. You have seen some of that gap really narrow because of that tech leadership. Do you think that that broadening trade still exists, or is it kind of just big tech going to be driving this market through the end of this year?
I think broadening out, it has happened and can continue to happen. But I believe in a secular bull market. For that to be intact, your leadership has to be intact. So if we've lost tech, you lose the market. That's my philosophy. So I actually still believe in tech. And, you know, if I look at the technicals, the one index we don't talk about anymore that I think is more significant, and I know the name isn't as sexy as Mag 7, is the FANG index.
Oh, my
Because
goodness.
it's a little bit broader.
I thought you were going to say the Dow.
No,
That's an
FANG,
inside
because
joke.
I get more of tech and tech related. And there's nothing broken in that index. It's churning. I think you're getting a rotation within tech, but I think it's setting up to actually take back leadership within the marketplace. But that doesn't mean other pockets can't come along. I do like financials. I like the banks. I like the capital markets, especially if we can get M&A and IPOs. There's pockets of industrials that I like for the build out for infrastructure. So a broadening out can happen, but I think the leadership stays tech and tech related.
You know what the F used to stand for?
Facebook.
Facebook. Now it's Meta, and Meta has been on an absolute tear, up 16 straight days.
Was the N for Netflix, though?
Yeah.
And not for NVIDIA, right?
No.
Correct.
So what do you think about NVIDIA?
So,
I mean, does DeepSeek undermine, does the idea that DeepSeek was able to create a ChatGPT comparable product at a huge discount, does that undermine the valuation of NVIDIA?
Well, I think it's still questionable if it was really at a significant discount. But what I think that what the DeepSeek really shows is how fast technology is evolving. And that's a good thing. But semiconductors, I've liked semiconductors for a long time, and that was my top sector last year in 2024. But you get important rotations in technology, and the market is shifting to software. I think the big moves we've had in semis need to consolidate. So NVIDIA, although it's a company that I like longer term, wouldn't be my top pick for 2025. I think going into the software space will outperform semis in 2025.
I'm looking at, it takes me sometimes a while for something to dawn on me.
Right, right.
I'm looking at Meta, and you point out it's been doing well.
Yeah.
Is it up every day for the last
Last 16
3
days. That is the longest streak of any component of the NASDAQ 100 in data going back to 1990.
It's also a
according to
big
Bloomberg.
reason that the Mag 7 has still been able to become a leader in this market. A lot of those other parts of the Mag 7 have, wavered.
Yeah, it's undeniable, of course, Meta really having a fantastic start to 2025. Marianne, it's always great to see you. Hope to see you again in person soon. That is Marianne Bartels of Sanctuary Wealth. Meanwhile, speaking of tech, let's check in on Apple and Alibaba, because both stocks moving higher right now in the pre-market after a report that they are developing AI features for iPhone users in China. You can see on the other sides, Baidu falling on that news, down about 4% right now, Sonali.
Yeah, and coming up next, we're going to stick with AI. We're going to talk about the exclusive we had with Sam Altman, who says that Elon Musk is trying to slow down OpenAI. He discusses his relationship with Musk in an interview. We're going to bring you some of that next. This is Bloomberg.
Probably his whole life is from a position of insecurity. I feel for the guy.
You feel for him?
I do, actually. I don't think he's like a happy person. I do feel for him.
Let's get now to high interest, to look at what's making headlines around the world, starting with the trade tensions between the U.S. and Europe. President Donald Trump ordered 25% tariff on steel and aluminum imports. Those levies will hit some of America's closest allies, and the president warned that the rate may go higher. The European Union is promising to retaliate. Commissioner von der Leyen says unjustified tariffs on the EU will not go unanswered. They will trigger firm and proportionate countermeasures. But don't forget, this isn't supposed to go into effect until like 3 or 4 weeks from now. So there's a lot of time to call it off. Elliott Investment Management has built a stake of around $2.5 billion in Phillips 66. Bloomberg sources say the activist investor plans to push the oil refiner to sell or spin off its midstream business. Elliott first disclosed a stake in 2023 and has since named a new board member and sold assets. It's part of a cost-cutting initiative. And it may have started as a side hustle, but in less than 2 years, Chinese AI startup DeepSeek could turn its founder into one of the world's richest people. The company is worth anywhere from about $1 billion to $150 billion. That's a massive gap, but that's according to 7 AI experts and startup founders who spoke to Bloomberg. So varying opinions as to how much it's worth.
Varying opinions and more billionaires to talk about here and more titans of the world of artificial intelligence. Sam Altman says that OpenAI is not for sale after a group of investors led by Elon Musk offered to buy the nonprofit that controls OpenAI for $97 billion. Musk's xAI is a direct competitor, and he has repeatedly taken legal action against OpenAI's practices and mission. Altman sat down with Bloomberg to discuss his relationship with Musk and his plans for OpenAI.
Look, OpenAI is not for sale. The OpenAI mission is not for sale. Elon tries all sorts of things for a long time. This is this week's episode.
You take it seriously at all? What do you think he's trying to drive at with this?
I think he's probably just trying to slow us down. He obviously is a competitor. He's working hard and he's raised a lot of money for xAI, and they're trying to compete with us from a technological perspective, from getting the product into the market. And I wish he would just compete by building a better product, but I think there's been a lot of tactics, many lawsuits, all sorts of other crazy stuff. Now this, and we'll try to just put our head down and keep working. Does it make it more difficult to move from that non-profit model to that for-profit model for OpenAI? We're not moving to a for-profit model. We're not sure we're going to do it all, but no matter what, the nonprofit will continue to be extremely important. It will drive the mission. It will continue to exist. The board is looking at lots of options about how to best structure for this next phase, but the nonprofit is not changing into anything or going anywhere. I mean, whether they did or didn't, they built a good model. Many people will distill from many other models. Again, I feel so confident about our research roadmap and also our product roadmap that, DeepSeek will do whatever DeepSeek's going to do. Other people do whatever they're going to do. And we're just going to try to build the best technology we can and get it into people's hands. And I think that's mostly going pretty well. Do you think Musk's approach then is from a position of insecurity about xAI? Probably his whole life is from a position of insecurity. I feel for the guy. You feel for him? I do, actually. I don't think he's a happy person. I do feel for him. Okay. Do you worry that he has this proximity to the president and he can influence the decision-making of the U.S. presidency and policies around this agenda on AI? Not particularly. Maybe I should, but not particularly. I mean, I try to just wake up and think about how we're going to make our technology better.
Bloomberg's Tom McKenzie conducted that interview from the Paris AI Action Summit, and he joins us now. Tom, great reporting, man of the hour over there in Paris. So a hostile bid for OpenAI, you could call it, but Sam Altman obviously coming out with some hostile words of his own for Elon Musk.
Yeah, look, it's getting personal now. This history, of course, goes back to 2015 when the two co-founded OpenAI and, of course, famously have fallen apart as a result of what Elon Musk says is Sam Altman's push and drive away from some of the founding principles around open source models, around safety-focused models, and around non-profit. That is the allegation, of course, of Elon Musk, and Sam Altman pushes back very strongly on that, talking about the fact that this is a man he thinks now, Musk, is someone who is insecure, is unhappy in his life. It has taken a personal twist, and it is the latest gear shift, of course, in terms of Elon Musk trying to pressure Sam Altman. It's also a reminder that there is an arms race right now at a startup level in terms of who gets to control this revolutionary technology, if that's what you believe it's going to be. Who gets to control it at a startup level? And it's part of the conversation in Paris as well on a sovereign level as well. Nation states trying to ensure that they're not left behind in this race. And to some extent, this feud between Musk and Sam Altman distills that tension.
Well, I think important as well is who else might be behind the bid, how seriously to take it with the valuation that's been proposed, as well as the other potential investors, Barron Capital, Joe Lonsdale's VC firm, Ari Emanuel. Is the bid real?
Yeah, look, I mean, speaking to executives on the ground in Paris, off camera, I saw some eye rolls, some heads and hands when I asked them about this. A lot of them are not taking it seriously. Sam Altman says he's not taking it that seriously. He thinks it's just the latest chapter. But don't you have to take it somewhat seriously, coming from the world's wealthiest man, coming from someone with proximity, as he does, to President Trump? But you're right, the valuation gap is there, right? 97 billion versus 157 billion versus 157 billion back in October. About 300 billion is potentially the valuation right now as they try to fundraise maybe a 25% stake from SoftBank, above the 13% stake from Microsoft. The valuation gap is a mismatch. Yeah. Is he just, as you suggested, just trolling Sam Altman at this point?
100%.
Sam puts it in this perspective. It's a gear shift.
I mean, just because Elon Musk is the wealthiest man in the world doesn't mean he's beyond, seriously dank memes. He can troll with the best of them.
You think those memes are seriously dank?
Remember when everyone thought buying Twitter, now X, was a joke also?
Yes, and remember when he tried to get back out of that?
I'm still not convinced
remember when he raised all that money in debt markets that they're just paying back?
He ended up having to follow through on. Tom, great reporting. Really appreciate you taking the time. That is Bloomberg's Tom McKenzie joining us from Paris. Of course, a great interview with Sam Altman from Tom earlier today. Let's take a look at futures right now because we're still lower in the pre-market. Just minutes to go until the bells ring. The S&P 500 down about 0.4%, even more if you take a look at big tech, and even more if you take a look at the small caps. We'll take a look at the action and walk through it in more detail next. This is Bloomberg. All right, welcome back to Open Interest. You're taking a look at futures right now in the red ahead of the opening bell. The S&P 500 is down about 0.4%, and then it gets worse from there. I want to talk about Meta, though, because Meta also down pre-market, which is a shame because it just closed out 16 straight days of gains. That is the longest streak for a NASDAQ 100 component in data going back to 1990. And what's interesting is that if you take a look at the valuation, it trades at about 27 times forward earnings, which is lofty to be sure, but that's pretty much in line with the NASDAQ 100. So it's not off the charts expensive.
I think people are worried that we may get a breaking headline that Elon Musk is offering $247 to buy Meta. With a group, with Ron Barron and a couple of other.
It's a bit of vindication, isn't it? The conversation over the last couple of weeks around open source. This is what Mark Zuckerberg has really been pitching from the beginning when it comes. But coming up next for less than 4 minutes from the opening bell, we're going to discuss those market moves with David Kostin of Goldman Sachs. Stick with us. This is Bloomberg.
Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We are looking at futures that are down here. 0.4% for the S&P 500, a little bit more for the NASDAQ, 0.2%. And this is even more disappointing because it means Meta may close down after 16 consecutive days of gains. Longest streak going back to, what did you say, Katie? 1990s. 1990s. So
a little bit.
Pretty cool stat there. You see SNL, Saturday Night Live, ringing the bell down at the New York Stock Exchange. Some say it's a set, so it's, I think, appropriate. And then you see Global Star ringing the bell, GSAT down at the NASDAQ. In terms of the major averages, which have now been trading for 24 seconds, Katie, what do we see?
Well, now it's 27 seconds, and similar to the pre-market, you can see we're lower on the day, but it's very early. The S&P 500 off by about 0.3%. Of course, we had a big day yesterday. Then you take a look at big tech, also lower, like you mentioned, Meta coming under some pressure after that big run-up that we saw. The NASDAQ 100 off about 0.5%. And then even worse, if you take a look at the Russell 2000, currently off by about 0.7%. We are seeing bond yields climb once again, maybe putting some pressure on those small caps. But let's take a look under the hood, and let's actually go to Canada because Shopify revenue increased 31% last quarter. Also expects an increase in the mid-20% range for the current quarter. It was down as much as 9% pre-market due to free cash flow concerns. Shaking that off right now, Sonali currently up about 1.8%.
Yeah, the consumer is in full swing today. I'm keeping an eye on Coca-Cola here as well. They reported a rise in global demand as higher prices led to higher profits last quarter. Coca-Cola has been largely unscathed, even as budget-conscious shoppers pull back on spending. You have the stock up more than 4.4% as the market opens. Interesting after McDonald's. Also, some strong consumer names reporting this week, Matt.
Yeah, we talked about that yesterday. I think someone had brought fries into the studio, which was distracting me for the whole program.
At 9 in the morning?
Coca-Cola, by the way, has drastically underperformed the food and beverage ETF and the consumer discretion.
Discretion?
Yeah. Is it a discretionary Coca-Cola?
I think so. I mean,
or is it a staple?
Some would quibble on that point, but we'll have to check
Only
the
up
official.
8% in the past 12 months.
It's not very much.
And the
relative to
S&P, the broader market, is up 21%.
You know what's been up a lot recently?
Meta.
Yeah.
16 sessions, as you said. That's a pretty amazing stat.
Yes. Yeah, that is quite an impressive streak. But as we're talking about, the valuation's not too expensive. People keep telling us that it's a stock picker's market. It seems like this time they really mean it. You have to wonder how many people.
It's true. It's a $2 trillion company now, but lowball bids are en vogue.
Yeah. It's kind of plateauing now, not to kind of parse hairs about it, but it's interesting that you did see still continually it rising after that big CapEx spend. I think they set the tone for everybody else, DeepSeek
I think
or
we
not.
split hairs.
Split hairs.
We parse words.
You know, I never know my idioms. It's such a problem. That's going to my family today, I know.
I don't split hairs, obviously.
Anyways.
Let's bring in David Kostin from Goldman Sachs. He's the chief U.S. equity strategist there. And David, you know, we're talking about these consumer stocks doing well with earnings. They're able to raise prices. This is what I think is going to be fascinating when we get CPI tomorrow. How many have raised prices to start the year? But what's your take on earnings season thus far, and what do you expect for 2025? Because as I look at earnings expectations, we were so bulled up at the end of last year. I think the consensus on the street was like 14%. Now it's steadily come down. You were at 9 at one point. It's steadily come down to less than 11, and you've moved up to that level.
Well, we're pretty much most of the way through the reporting season for the quarter. And the report card is as follows. We have year-over-year growth of around 12%. So let's put that in perspective. Coming into the quarter, Matt, the expectation was year-over-year growth of around 8%. So 400 basis points, 4 percentage points of positive surprises. That matched the average for the last 12 quarters. So we've seen a pretty consistent set of beats. And if you want to think about that skew towards the larger companies, while 12% was the aggregate index year-over-year growth, the typical stock was reflecting year-over-year growth of around 7%. So again, you saw the impact for the overall index from the largest cap, some of the mega cap companies, which I'll mention in just a moment. But to your point you just mentioned a moment ago about the margins, well, margins improved by around 50 basis points for the overall index, and that's, again, pretty good. So you had about 5% sales growth, some margin improvement, skewed towards the larger cap stocks, the communication services and the technology sectors really driving the best results in the quarter, energy and industrials at the other extreme. That's pretty much summarizes thus far the reporting season.
Well, let's talk about the elephant in the room, and that, of course, is tariffs. When you're trying to model out what you expect for this earnings season and, of course, the full year earnings season, how do you have any real degree of conviction when there's this overhang, this question mark of what the tariff picture will actually look like?
It's an excellent point. So our baseline forecast, which is a model that focuses on revenue growth and margins at the individual sector level, leads us to a forecast of year-over-year growth of around 11%. That's 11% this year, 2025, relative to last year. And then looking into 2026, we're looking at earnings growth of another 7%. So 11% followed by 7%. That's a baseline. If we want to think about what are some of the scenarios, and obviously there's a series of changing news flow every day, but an increase in tariffs of around 5 percentage points for the average tariff rate across the country, which is currently roughly 3% or so, another 5 percentage points would reduce our estimates by around 1 to 2%. So therefore, instead of 11% earnings growth this year, it would be closer to 10%, probably trim 1 to 2 percentage points of growth off of our forecast. Again, that's a fluid number, a lot of variables, a lot of moving parts, and that's a big area of discussion with clients. not so clear exactly how companies are going to respond. They may push back and try to get the suppliers to perhaps adjust their prices to absorb part of that. Some of that's a negotiation. In some cases, they may try to absorb that themselves. In some cases, they may try to push that through to the consumer.
You know, speaking of the consumer as well and potential price shocks that companies might feel, in addition to tariffs, the concerns around immigration policy and what that might mean for the labor market. How are you factoring that into potential future EPS growth and ripple effects here for the consumer that has been showing up quite strong until right now?
So my colleagues in U.S. economics research have published a lot of reports looking at exploring some of the impact of the immigration in terms of the impact on the size of the workforce. From a fundamental perspective, as we think about the drivers of economic activity, it may trim slightly GDP growth, so it would have a potential modest impact on our overall earnings for the S&P 500 companies, but it's not likely, in our view, to have a significant impact on corporate profits in the coming year.
Yeah, I would think. I mean, in his first term, Trump deported 1 million people. So that's far less than Obama did. But if he follows through on those threats to deport a large portion of the workforce, I would think, David, that drives up costs. You know, labor costs. If you don't have anybody to rebuild the homes in L.A., if you don't have anybody to, do the jobs that some of these millions of immigrants are doing now, and there's no new labor coming in, don't you see, is that just a longer term problem or?
Well, if we'll think about it analytically, the labor budget for a typical company is around 14% of its sales. So, Matt, that looks at salary, compensation, bonuses, healthcare benefits, which, as you know, in America are paid through via the employer. So that wage bill aggregate is about 14% of the sales for the typical S&P 500 company. And that's going to give a range from maybe 5% at the low end to maybe 30% at the high end. So that would be a very high labor-intensive company. And so that's a way of thinking about the impact of and the proportion of labor costs as compared with, say, raw materials. Different industries, of course, have different labor intensities, and that has both impact from an inflation point of view, but also from an AI point of view and the artificial intelligence, which industries may be more or less likely to benefit as a result of maybe the efficiencies that might be gained through the point of AI. So it's a huge topic of interest to portfolio managers. We focus on this a lot in our own research and thinking about which companies may or may not be more negatively or positively affected from their margin point of view specifically.
All right, David, unfortunately, we have to leave it there. Great to get some time with you. That is David Kostin of Goldman Sachs. Now,
and I learned something.
You did?
Yeah. I mean, that is fascinating. 14% on average is labor costs.
Yeah.
And obviously, if those prices are driven up by one thing, deportations, they could be also driven down by AI.
A lot of investors banking on that productivity initiative. Let's see if it comes through fast enough to offset any potential price hikes.
All right, coming up, hedge funds are eating into clients' gains with no limit fees. More from Bloomberg's latest analysis next. This is Bloomberg.
We want to bring you some breaking news out of Goldman Sachs. The company is killing its IPO diversity pledge as DEI programs come under fire across the country. Joining us now with the latest, Sridhar Natarajan, Bloomberg's chief Wall Street correspondent. You think about when they made this pledge in 2020. The idea was to have one diverse board member. They increased it to 2. It came out with a lot of pomp and circumstance. So what is now the mood, both among Goldman employees and their clients, to now roll this back?
It certainly came with a lot of hype, because remember, when they announced this back in 2020, this was David Solomon high up in the Swiss Alps talking about this policy and professed their unwavering commitment to diversity. This was a time when across corporate America, and especially financial firms, were leaning into this idea that diversity is important and they need to encourage it, and they need to find ways to encourage it. State Street and BlackRock were using their voting power on a bunch of different companies. Goldman, the leading investment bank on Wall Street, came out and said, we will refuse to take a company public unless it has at least one diverse board member. So it effectively was supposed to be the end of the all-white, straight male boards. They even upped the ante and made the requirement 2 for companies that they were taking public in Western Europe and US. Well, today they've formally confirmed that they have backtracked. We've already seen one or two companies where that policy certainly slipped away. And you have to see what's happening in the broader environment. There's obviously everything that you've seen change since Donald Trump re-entered the White House. There was, of course, the NASDAQ board diversity rule that was killed in the Fifth Circuit as well. All of these things played a fact, and this is Goldman just acknowledging, and this is a nod to the time that we're in.
Yeah, well, I was wondering that. I mean, you have to wonder, is this a direct response to Trump? But then you bring up the NASDAQ point. I mean, that predated the inauguration.
And again, it's not entirely clear that if this was, say, a Democratic administration, if this was a Harris administration, even with that legal precedent, would Goldman Sachs necessarily have killed this initiative? Would other companies have killed their DEI hiring goals? Because this is a board diversity push, but there were other things that people were putting in place, including rank and file, how many people they were hiring, what the makeup of their new hire should be, how many people they were promoting, what their executive class should look like. It's hard to imagine a scenario where you can definitively say that President Donald Trump, once again, did not play a role in this, even if we cite all the legal precedents.
And in the statement to Bloomberg News, Tony Fratto, the spokesman for Goldman Sachs, said legal developments related to board diversity requirements caused them to end the formal policy. So 5 years, come and gone. Bloomberg Sridhar Natarajan, we thank you so very much for your time today. We're going to now move to today's big take story, hedge funds. We're going to move to the hedge fund industry because they have been eating up client gains with their pass-through fees. A Bloomberg analysis of regulatory filings spanning over a decade details costs ranging from copy paper to private jet flights. Hema Parmar co-wrote the story, joins us now. Hema, this is really indicative of a massive trend this year where you're seeing, yes, certain funds do very, very well, but that talent war get more and more heated in the hedge fund industry, meaning that these pass-through fees, despite how much certain investors might hate them, have been status quo, haven't they?
Yeah, pass-through fees are the most coveted perk of running a multi-strategy fund. You get the investors to pay for pretty much all the costs of running the firm. And so what we're seeing is that, our analysis of the disclosures shows that the number of fees disclosed has increased by 40% over the past 5 or 6 years. And, we really see how the costs of these pass-through fees can eat into returns when a fund doesn't do so well. So if we look at the Balyasny example, that fund produced a gross return of 15%, but because the costs of the pass-through fees, most notably compensation, were so high, it ate into returns such that investors only walked away with less than 3% in gains.
I was actually going to ask, what's the biggest expense?
Yes.
I thought maybe it would be private jets. I understand that they're a necessity because I just flew commercial to Indonesia and back, and it shouldn't be allowed. But I guess compensation is going to be the big one.
Compensation is the chunkiest by far. If we look at Balyasny, they spent over $600 million of their more than $700 million in pass-through fees on compensation. We see hundreds of millions of dollars in compensation fees. And that's because you're looking at an environment where there's a fever-pitch talent war. You're seeing pay packages for some of these traders reach the $50 million range, $30 million range. And the firms would say that that's because you really need to get the best talent to build these gigantic shops, but they can really weigh. And so it depends on how a fund is doing. If a fund's net return is great, then maybe investors don't mind paying those fees. But if the performance is mediocre or poor, then they might think twice.
Hema, don't mind paying those fees. Matt asks a lot why investors are investing in hedge funds if they're trailing the S&P 500, even though that's not the benchmark. It's an asset management, it's a portfolio management question. You're paying for diversification, perhaps. But if even then the fees are getting eaten up, or eating up the returns, rather, are you starting to see investors complaining about the all-in return that they do get back to them?
Some investors do complain. It really depends on the fund that they're in, and it depends on the return that they expect and what they see. So the general expectation is that a multi-strategy fund produces about 1% a month, 12%-ish a year. And so, and the hope is that they don't lose your money. So some of these firms have never lost money or only lost it once in their 20-year history. And that's what you're betting on, the reliability, the consistency, and investments that are not correlated to the market.
By the way, when we show these performance figures, Hema, are they net of those fees?
That's a net return, yes. But when a fund is mediocre, if you're producing less than that 12% threshold, if you have multiple consistent years of not meeting investor expectations, then those costs, you're looking at them again. And you're wondering, okay, well, what am I paying for?
Yeah, especially when actively managed ETFs could be only charging 7 basis points.
That's true.
Hema, thank you very much. Hema Parmar there talking to us about hedge funds. I know different benchmarks, completely different. Apples and oranges, I get it.
No, but that's a lot of fees
Still.
to just not be handed back in terms of returns. So
when we come back, we're going to focus in on Humphrey Hawkins. That's what we used to call these semi-annual.
I love these testimonies. I'll be honest with you.
Yeah, Fed Chair Powell is at Capitol Hill. Day one, this is Senate day of his monetary policy testimony. We'll take a look at what the market is anticipating next. This is Bloomberg.
All right, we're just about 10 minutes away from Powell's Senate testimony. He also testifies tomorrow in the House. We also get CPI, PPI, jobless claims, and retail sales data in the span of just 3 days. Let's preview it all now with Stuart Paul of Bloomberg Economics. Great to see you, Stuart. So we'll start with what's happening in 10 minutes, of course, the Senate testimony. And it seems like reading the sell-side research ahead of the testimony, Powell will want to try to not make news here, but what do you think some of the hottest topics of discussion will be?
There are some items that are especially predictable. We know that Senate Democrats are going to come out, probably Elizabeth Warren, starting with a question, why did the Federal Reserve withdraw from an agreement to green the financial system? She'll probably press Chairman Powell on how secure the CFPB's funding is, because, again, they don't get it through congressional appropriations. They get their funding from the Fed. We can expect Senate Democrats to push.
Wait, haven't they requested $0 in funding?
So
that would seem to be very secure.
We know that Russ Vogt, former OMB director, is now temporarily running the CFPB, but because again, it's sort of a peculiar appropriations process, we'll see what happens there. Maybe more market relevant is just how forcefully Senate Democrats are going to be pushing for additional rate cuts this year, and also probably more market relevant is whether Senate Republicans will get aggressive in asking Chairman Powell about the effect of the national debt, fiscal sustainability, and so on.
You have to understand the CFPB issue. I know that it's something that's been kind of amorphous and a lot of pushback already, but it's something where bankers across the street are breathing a massive sigh of relief, too, because this is potentially billions of dollars in overdraft fees and credit card fees that might stay on the table now that might have otherwise been challenged.
Bankers breathing a sigh of relief. I don't know about the consumers.
By the way,
right, exactly.
Otherwise, what? You're allowed to overdraft, so you essentially borrow money from the bank for free?
These have been super challenged over the last several years. There's a lot of debate about whether they should exist or not, but it is interesting because of the Fed oversight of this, too. A lot of people believe that there's a duplication of the issue here, too. But anyways, beyond the CFPB, which, of course, is a huge issue, how are they going to just handle the issue of inflation, right? This is before the CPI data comes out, which makes some of the challenge here a little difficult because there's so much you can't say.
It is, that's right. You have to wonder. We heard earlier this morning from Beth Hammack, Cleveland Fed president, who came out saying that inflation risk is skewed to the upside. You have to wonder the extent to which she's coming out ahead of Chairman Powell in his testimony, provide a little bit of breathing room so that he can say something maybe not the same, but similar. Maybe that, for example, the Fed is well positioned to respond to upside and downside inflation risks. I think that Chairman Powell is going to attempt to rebuff requests from the Democratic members of the Senate who are pushing for swifter rate cuts, and instead say that the Fed needs to remain rather nimble and keep its options open, especially given all of the policy uncertainty that's coming out of the executive branch.
How does the labor side look to you now that we've had a few days to examine the non-farm payrolls number? I saw Torsten Slok sent out, an alert that someone said weather really did hold the number down. The averages were good. How does it look?
Yeah, so undoubtedly the January numbers were affected by the polar vortex in the lower 48 states. There was also very minor effects from wildfires in Los Angeles. But beyond that, separate from what I think that Chairman Powell is going to be very clear in saying that the labor market is currently solid, but wage pressures emanating from the labor market are starting to dissipate. We do see that a little bit when we look at job openings data relative to total unemployment, where the total relationship between supply and demand for labor is starting to come into better balance.
All right, Stuart, got to leave it there. Great preview. That is Stuart Paul of Bloomberg Economics. A much more markets coverage coming up ahead of that testimony. This is Bloomberg.
Do you mind if you just step up?
This is Bloomberg Open Interest. You're looking live at pictures of Capitol Hill, the epicenter for markets this Tuesday morning, as Fed Chair Jerome Powell prepares to deliver his semi-annual testimony before the Senate Banking Committee. We used to call that Humphrey Hawkins. Powell's testimony comes as President Trump's proposals on trade, taxation, immigration, and regulation cast uncertainty over the economic outlook. And we want to get to Bloomberg's Mike McKee on Capitol Hill with the latest. Mike?
Well, Matt, if you read the Fed's last policy statement, you have the gist of the chairman's prepared testimony. Not much in it to guide markets or senators. He repeats the Fed's assessment that the economy is strong overall. The labor market remains solid without much wage pressure. And inflation has moved much closer to target, though it remains somewhat elevated. The drop in inflation made their 100 basis point recalibration, as he put it, of interest rates appropriate. From here, they are well positioned. They can cut rates more if the economy weakens or raise rates if inflation rises. To the extent there is market guidance, he repeats, with our policy stance now significantly less restrictive than it had been and the economy remaining strong, we do not need to be in a hurry to adjust our policy stance. There is no mention of fiscal policy, tariffs, or taxes, no mention of the president or the new administration. Powell's testimony also does not touch on bank regulation or DEI, two subjects that may get a lot of attention from committee senators. Chairman Tim Scott has already said that bank rules are at the top of his questions list. Powell does mention the Fed's monetary policy framework review, suggesting it should be finished by late summer, and repeating the committee's 2% longer-run inflation goal will be retained and will not be a focus of the review. Committee members are more likely to be concerned with and ask about the Fed's current strategy of letting the economy run hot to help minority and low-income workers get jobs. Republicans have said that helps contribute to the outbreak of inflation that we had. So pretty anodyne opening statement, trying not to take positions or send signals. We'll see what happens with the questioning.
Well, to that point, I want to go back to what he didn't say, because those feel like some pretty big omissions, Mike McKee. You think about tariffs, immigration policy, of course, the president himself. What else didn't Powell talk about?
Well, you know, he's very reluctant to talk about tariffs or fiscal policy because the Fed yet doesn't know what it actually will be or how it will affect the economy, and that's probably all he's going to say on it. One interesting thing, though, that he didn't talk about that he did in the last Humphrey Hawkins testimony was that inflation expectations have started to rise. Last July, he said they were still well contained. But if you look at what's happened with both the University of Michigan consumer side and break-evens in the markets, they've started to go up, which perhaps worries Beth Hammack a little bit. You talked about her testimony earlier, her speech earlier, and that's something that may come up as well today.
One thing I wonder, and I do feel like these hearings say as much about Congress as they do, of course, about the Federal Reserve. There were certain things that were brought to the Fed by law. For example, some of these DEI programs that now will be under question were on the heels of the Dodd-Frank Act. Is there anything that he could say today that would sway the course of policy making moving forward?
Not really. Basically, he'll say the Fed, while an independent agency, tries to follow the general direction of the administration, and the Fed has already taken down some DEI web pages, but he's not going to say anything that would probably lead the senators to criticize the Fed's position on that, except perhaps for that monetary policy framework.
We're looking for CPI tomorrow, year over year, Mike, at 2.9%. The core number at 3.1%. Still a long way off from the Fed's target. And I know, they prefer PCE to the Consumer Price Index. But is there any push inside the Fed to work and get this inflation number back down closer to 2%, or are they comfortable with 3%?
No, they're not comfortable with 3%, and the consensus among all Fed officials is they are going to work to get inflation down. They're going to keep the pressure on, which is one reason that they're in no hurry to cut interest rates. Now, I suppose you could read Beth Hammack as the most hawkish of them all, suggesting maybe they might even have to raise rates, although she did point out some ways in which inflation has been easing. But at this point, the Fed is going to take as firm a stance as possible on inflation.
I want to talk a little bit about political pressure here. We know that Jerome Powell is going to be getting some tough questions from both sides of the aisle. Of course, we were just walking through with Stuart Paul what we're expecting Elizabeth Warren to say, for example. I want to talk about the man at the top, though, Donald Trump. I thought it was very surprising. On February 2nd, he said that actually holding rates steady at their last meeting was, quote, the right thing to do. It seems like maybe some of that pressure coming from Donald Trump has eased a little bit, Mike McKee. I know it's early yet.
It's early yet, and of course, Trump has a tendency to change his mind on a moment's notice. So we don't know exactly what he will think of all this. But members of Congress are going to try to, especially Republicans, divine what they think the president is thinking. So you may get some tough questions about monetary policy going forward, or, as you point out, on Capitol Hill, you get a lot of tough statements as opposed to questions. But Powell is going to try to take as neutral a stance as possible, say they stay in their lane, they do monetary policy, they don't comment on fiscal policy, they just react to whatever happens to the economy because of those policies.
When we think about the course of inflation as well, how much will he be peppered around just the direction of inflation as it stands today? I mean, CPI is not out until tomorrow, PPI Thursday. Is that going to be the bigger event?
Well, the direction is lower, right?
But a lot of investors concerned that it's stalling, and the stalling of it is what is really causing some chorus of alarm here, or at least enough to push out any expectation for a rate cut to as late as September.
Well, it's interesting. If you look at Beth Hammack's speech, and of course she's the most hawkish of them all, she does point out some areas in which inflation is starting to improve, including on the rent side, which should push down inflation overall as it works its way into the way the Bureau of Labor Statistics calculates the CPI. There are some other areas, she notes, where prices are starting to ease, but there are still some areas that are firm, and that's what the Fed has to be concerned with. One thing that's likely to happen is that year-over-year inflation will start going down for a while because of base effects. Last year's inflation higher, so this year it would take more to push it up. And we may see some improvement going forward, but the Fed's not going to hang anything on that. They're not going to say by June we could be cutting rates. They're not going to give a timetable at all at this point.
If you look at the chart, I mean, a year-over-year chart of the core, Mike, which I'm sure you look at on a daily basis, we peaked at around 6.5%, a little bit more, and we are coming down. The last reading, I think, 3.2%. We're looking for 3.1 tomorrow on the CPI core. So it is coming down, maybe not quickly enough for a lot of people. Here's a great picture of the Bloomberg graphic. In terms of why Donald Trump isn't pushing back, Katie brought this up. We have heard from Scott Bessent, Treasury Secretary, that they're more concerned with longer-term rates, more concerned with the 10-year yield. What do you think about that approach? Because we heard that previously, you may remember, from Robert Rubin about 30 years ago. And the Clinton administration had a tough time with yields as well.
Well, that might be a lesson learned by some people in this administration. The Fed controls the short end. They do not control the long end. That's the markets. And so Jay Powell has said that before. He probably will repeat it at some point over the next 2 days. And if the markets think that we have a potential inflation problem, or conversely, a weakening economy problem, that'll show up when you get out to the belly 5/7 and farther. The Fed can't do anything about the market reaction. reaction. And so maybe the administration is recognizing that where they are, the Fed at the moment, is about as good as they can do given the information they have.
I think that's really interesting, those comments, and I haven't had a chance to talk about it with you guys because it feels like this time around this Trump administration really focused on the bond market, not as much on the equity market, which is really interesting. It's the bond market, it's the long end, and to your point, there's not much they can do when it comes to the long end.
Well, there is, in fact, something they can do.
Quantitative tightening.
I was going to point out that the Treasury's gold holdings at 261 million ounces are currently valued at $11 billion, or $42.22 an ounce. Mike, you may have seen this story in the FT a couple of days ago. If they mark that to market, the gold holdings would be worth more than $750 billion. And they would then have to, if they used a repo agreement with the Fed, have to issue far fewer treasuries. There would be less supply in the market, and then people would, I guess, be willing to pay more for those treasuries, driving yields lower. What do you think about that, Mike?
Well, it's certainly an accounting sleight of hand that could be done by the administration. Previous administrations have thought about it and rejected it. They're not sure the market reaction would be as straightforward because people recognize it's just accounting on paper as opposed to what your debt situation actually is. But it is something that they could do, and if the government wanted to do that, the Fed would pretty much have to go along. So I suppose that could happen. It's not getting a lot of traction, interestingly enough, Matt, in the markets. You don't see a lot of talk about it from the analysts at this point, although the FT did bring it to the fore this week.
Well, who knows? Maybe Elon Musk is watching right now, and that'll become a Doge initiative. But this is more of a Treasury conversation. But in terms of what could impact the long end, I suppose they could mix up their issuance mix, their schedule there. But we know, Mike McKee, because we got the refunding last week, that they don't really plan to deviate from what Janet Yellen was doing.
Well, I think what's holding them back at this point is both not knowing what their own president's policies are going to be and how those are going to impact interest rates, but also the fact that they have to come up with a government spending plan by March 14th. And also that's when the debt ceiling, the debt ceiling actually could maybe go into the summer, although they're saying they have a little less money on hand than they thought. But those two issues will keep them from, at this point, making many changes in what the maturity, issuance, and size is. So at this point, it makes sense that Scott Bessent is saying we're not going to make any changes. But I would imagine that once you get into the summer, if those problems get behind them, that he might follow through on what he said about wanting to term out some of what the Fed or what the Treasury is selling.
Michael, no one wanted to talk about kind of, what is it, the ugly stepchild here? What is the saying?
Redheaded, I believe.
Redheaded.
The ginger stepchild.
The quantitative tightening plans, the Fed's balance sheet. No one wants to talk about it. But I mean, ultimately, what does it mean in terms of their ability to control the long end, if at all, and potentially mitigate or mess with more refunding that could be coming sooner down the pipe?
Well, depending on how long they keep going and when and how fast they stop, it could have implications, but more likely for the short end in terms of what the Fed is going to be letting come off, which people use for rehypothecation, for repo transactions. If there are fewer treasuries, then that's going to drive up the short end cost of lending them. And so that is an impact that markets are keeping an eye on. But so far, the Fed's not giving us any hints of when they think they're going to stop. Markets are betting somewhere between the summer and the end of the year. But we're still waiting for Chairman Powell or anybody on the Fed to give us a better clue. He does say that they continue to lower their balance sheet, but that's the only remarks on that he has in his prepared testimony.
By the way, I think no one wants to talk about the elephant in the room.
Thank you.
The redheaded stepchild, and I'm not making light of this, but the idiom is beaten like a redheaded stepchild.
Beaten? What?
I know, it's horrible. It's horrible. I think it's awful.
You know, we have our Barry Knapp from Ironsides writing it also about the idea here that the Fed has been, so to speak, controlling the back end of the curve. And there is that kind of thought out there around this quantitative tightening plan and how that.
Well, also around issuance as well, which we're talking about with Mike McKee here. And Mike McKee, of course, we have The Senate today, we have the House tomorrow. Are we expecting any differences there in terms of tone, in terms of noise and substance?
You usually get a big difference between the House and Senate. The House tends to be more political. The Senate tends to focus more on issues. I noted that Tim Scott, the chairman of the Banking Committee, has already said that his primary line of questioning is going to be on bank regulation. So I would expect more of that. And of course, Elizabeth Warren will, as always, come loaded for bear. She's probably in a bad mood about the CFPB. So she'll probably focus on things like that. Whereas the House will be much more interested in scoring political points and in getting some video to put into TV commercials.
Jay Powell speaking now. Mike McKee, thanks very much for that.